Welcome to the deep dive. Our mission today is to uh, really get you the key insights from the latest reporting on next generation industry and global finance.
That's right.
We're looking at everything from future semiconductor strategies, the kind of chaotic AI market, all the way to how different countries succeed at retirement planning. We're here to give you the shortcuts.
It's an interesting mix of sources for sure. You've got cutting-edge manufacturing on one hand, and then the future of long-term personal wealth on the other.
So where should we start?
Let's start with the hard tech. The government is pushing these 15 super innovation economic projects, and, well, we're finally seeing some of the corporate heavyweights step up.
And that brings us directly to SK Group. They've signed on as the anchor enterprise, the lead firm for the government's power semiconductor project. This feels like a big shift
It is.
because, large conglomerates have traditionally stayed away from this specific kind of national project. So what makes this so important, and what exactly are these power chips?
Well, what's fascinating here is that this is the very first time, a major domestic conglomerate has joined this specific government-led initiative.
Okay.
And power semiconductors, they're not the memory chips like DRAM that everyone talks about. These are the components that control and convert power. Think of them as the nervous system for electricity itself.
So less glamour, more grunt work.
Exactly. They are absolutely crucial for anything that uses high power efficiently. So electric vehicles, huge data centers, and even the next wave of robotics, like humanoids.
And their key feature is the material, right? You mentioned silicon carbide or Psyche.
Right.
Why does Psyche matter so much?
Think of Psyche as a major engineering leap. When you move power through conventional silicon, you get a lot of wasted energy and heat.
And heat is the enemy.
Heat is the enemy, especially for batteries and compact servers. Psyche drastically reduces that power loss and the heat it generates. It just lets you build lighter, more efficient systems.
So the market must see this potential.
Oh, absolutely. The SiC sector is projected to grow by something like 20% annually, hitting over $10 billion by 2030.
That's a huge growth curve. So what's SK's specific role in this one-team strategy?
SK is basically building out the private sector value chain. So that's everything from the 6E wafers, the raw material, all the way through advanced packaging and post-processing.
And the government's job.
The government's role is to kind of weave together the whole ecosystem. They connect the key universities, the research institutes, and smaller specialty firms to create this unified one-team structure.
Okay, so government officials are calling this a potential game changer. I've even seen them compare its impact to high bandwidth memory, HBM.
They have.
But HBM had, immediate proven demand from giants like NVIDIA. Isn't this 6 project a much higher risk, longer term bet? Are we maybe getting a little ahead of ourselves with the hype?
It's definitely a longer-term bet, I agree. But the analogy to HBM is more about the strategic value. HBM changed the supply dynamics for high-end GPUs almost overnight.
I see.
So if SK can establish a robust domestic SiC value chain, it secures a future technology that's critical for, say, energy independence and dominating the EV market. It's about securing that next foundational tech before the global supply chains harden.
That makes sense. Okay, let's pivot from the future of chips to the immediate chaos in the current chip market. The AI boom is causing massive DRAM shortages, and it's forcing a big shift in how contracts are written.
The demand intensity right now is it's astonishing. Market sources are saying the current buying fever is even stronger than the infamous 2017 super cycle.
For our listeners, can you quickly break down what super cycle means here?
Sure. It just means a period where demand skyrockets and stays high for an unusually long time, which pushes prices way up. It's usually caused by a big foundational tech shift. Back in 2017, it was the rise of mobile computing.
And now it's AI.
Now it's AI.
And this pressure is causing just massive price volatility.
Absolutely.
Yeah.
Just look at the benchmark DRAM, the DDR8 gigabit. In the first quarter, it was trading at about $1.35. By the end of October, it surged past $7.
Wow. Over 500% in 9 months.
Imagine being the purchasing manager who missed that window.
Mm-hmm.
Your budget for a basic commodity just exploded.
That kind of volatility has to change how business is done. How are the contracts shifting?
So traditionally, DRAM contracts were renewed monthly, maybe quarterly, very reactive.
Right.
Now, because these global big tech firms are desperate to lock in their supply, contracts are moving to a minimum of 6 months. Some are even longer. It's become an advanced purchase model.
That sounds less like buying a commodity and more like futures trading.
It is. The industry has basically adopted a futures model, which used to be reserved only for really specialized components like HBM.
And what's really telling here?
What's truly insightful is that some of these big tech firms are already negotiating DRAM supply volumes for 2027 with Samsung and SK Hynix.
2027, they're thinking that far ahead.
They are. This isn't just a short-term crunch. It signals that the world's biggest memory consumers believe these shortages are going to be structural. They're going to be with us for years.
Okay, let's shift gears. We've talked about short-term panic and long-term tech investment. But what about the most important long-term investment for you, the listener? Retirement. We've got some fascinating data comparing the huge success of the U.S. 401k system to others.
This comparison is really stark, and it reveals a critical lesson about financial culture.
Which is?
The core difference is whether the system promotes saving or investing. Over the last decade, the average annual return for U.S. 401k was 8.07%.
8%. And how does that compare?
Or you compare that to a lot of other systems. Their equivalent plans were getting returns closer to 2.52%.
That difference might sound small year to year, but over a decade, the compounding effect must be explosive.
Precisely. Let's put it in numbers. If you invested, say, $100 million in 2015 in the U.S. system, that money is worth over $217 million 10 years later. In the 2.52% scenario, that same money only grows to about $128 million. That is a nearly $90 million difference just from a different investment culture.
So how did the U.S. pull this off? What's the secret?
It really comes down to asset allocation.
Mm-hmm.
In the U.S., retirement is treated as a long-term investment. So young workers, people in their 20s and 30s, have around 90% of their assets in stocks.
Taking advantage of that long time horizon.
Exactly. They benefit from long-term compounding. In contrast, you see many other systems where the vast majority of assets are locked into these low-yield, principal-guaranteed products. They're basically earning simple interest while the U.S. funds are getting that exponential snowball effect.
And the engine behind this is something called a target date fund, or TDF.
TDFs are the core behavioral driver. They're brilliant, really. They are often the default investment option, which means you have to actively opt out of investing.
That's a key detail.
A very key detail. And TDFs automatically adjust your investments based on your age. When you're young, you're heavily in stocks. As you get closer to retirement, it automatically shifts you into safer bonds.
So it takes the guesswork and, frankly, the fear out of it for the individual investor.
Exactly right.
Yeah.
And you can see the results. Over the past decade, the amount of money in TDFs inside 401k plans has surged. It now accounts for 42% of all 401k assets. It's created this virtuous cycle of long-term stock exposure.
What I find really interesting is that the system isn't standing still. It's now looking beyond just stocks and bonds.
That's the next frontier.
Yeah.
The U.S. system encourages fierce competition among asset managers, which drives down fees. But now it's also expanding what counts as an appropriate retirement investment. Back in 2020, the Department of Labor confirmed that including alternative assets, things like private debt, infrastructure in a TDF, doesn't violate their duty to the investor.
That's a huge stamp of approval for putting less liquid assets into these funds.
It is. Firms like JP Morgan are already moving into this space. And there's another potential paradigm shift coming, with the executive order allowing for virtual assets, like Bitcoin ETFs, to be included in retirement accounts.
So you're seeing the democratization of really sophisticated financial strategies, all because of the need to provide people with a decent retirement.
It just raises the bar for everyone.
Okay, finally, let's wrap up with a look at the domestic biotech sector. We're looking at the big three Altiozen, ABL Bio, and LGC Biome. What's their financial health look like right now?
In a word, strong. The cash is flowing. The combined cash assets of these three hit an all-time high of over $300 billion in the third quarter.
That's a 54% increase over the previous year. For R&D heavy biotech, that's a huge surge. Where's all that liquidity coming from?
And that's the critical insight. It's not from external fundraising. It's from success. It's coming from commercialization.
Okay, so deals with bigger companies.
Exactly. These reserves are built from technical export agreements with global pharmaceutical companies. We're talking upfront payments, milestone payments as trials progress, and crucially, royalties.
So they're graduating from that precarious startup model, always looking for the next round of funding, to more of a self-sustaining big pharma model.
That's the virtuous cycle right there. They can now fund their own R&D internally without having to dilute shareholder value.
Yeah.
And the growth is just extraordinary. Altiosen's cash reserves are up 290% year over year. ABL Bios are up 109%.
So the big question is, what do they do with all this new financial firepower?
Well, experts project they'll follow the classic growth path of global big pharma. They'll use this cash to aggressively pursue mergers and acquisitions,
Ah, so buying up smaller companies.
buying up promising early-stage pipelines or specialty tech platforms to rapidly expand their scope. This shift from being a pure research house to a strategic consolidator, it's a major maturation point for the whole sector.
So that wraps up our look at next-generation semiconductor investment trends and innovation in global financial markets. We'll be back again soon with more of the latest insights. This has been The Deep Dive from the Seoul Economic Daily. Thank you for listening.